investors. Welcome to REI Mastery U's Professional Investor Class number 7. I'm Jeff Brailio, your guide for today. Remember that knowledge is power, power to do more deals, power to do more profitable deals, and power to do more protective deals. Hope you enjoy the class and learn a ton, so here we go. This is the last of our Professional Investor online program series, class number 7 on real estate taxation essentials. And before we get started, just kind of a disclaimer that this video and content is for educational purposes only. It's not meant for legal, tax, or financial or investment advice. You are encouraged to seek the counsel of your own professional advisors before engaging in any financial investment. Okay, this is kind of basic stuff. It's fun stuff. You're going to have to deal with taxes your entire career in real estate. There's a lot, believe it or not. There's a lot of tax issues in owning real estate, both good and bad. There's a lot of reasons we own real estate for the tax benefits. And as long as you know how certain things are taxed, you can certainly save taxes, reduce taxes as best you can. And so this class really is kind of an introduction into how real estate is taxed generally. We're going to go over the two major types of income that you receive that most investors get through real estate investing and how those are taxed. So we can cover the vast majority of real estate investment techniques in the taxation, but they do form the basis for many other kinds of real estate investing you might do. And then of course you can get much more complicated and with a lot of other tax saving strategies. We'll introduce some of those at the end, but keep an eye on some of our webinars for special guests and stuff to talk about more specific tax strategies. So this one is just kind of a follow-up. If you watched our 3 LLCs used in real estate, it's a free video on our homepage. We do talk about the tax savings LLC in that. We just sort of introduce it. We're going to talk more about the tax savings LLC here and specifically with some numbers of how you save on taxes. To begin with, though, we need to really kind of, just like we did in class number 1, in this professional series on liability, we had to take a step back and talk about actually liability and where liability comes from. So you understand the basis of the asset protection. Here, and when we're talking about taxes, you need to understand the basis of how most taxes are sort of generated and assessed so that you can then apply it in lots of situations. So this is kind of, again, backing up, not just like, here's how to save taxes on real estate, but here's how Americans are taxed. In general, there's 2 kinds of income that people receive, either passive income or ordinary income. And the ordinary income is the appropriate tax word. That's what the tax code calls it. I always use the word active. I like passive and active. They're opposites. They make sense to me. So you may hear me throughout this kind of say passive versus active income. But if you talk to your CPA is probably going to use the word ordinary income. But those are the same thing. So let's start with passive income first. That's the great one. That's one we all want. Passive income is income that is generated by owning an asset. And with the intent to own and generate income from that asset over the long term. Okay, 2 shining examples. Owning a stock or bond. Okay, simply by owning a stock share in a corporation entitles you to distributions based on how much stock you own from that company every year. And the bare fact that you own the stock entitles you to those distributions. Okay, so you don't have to work for it. You don't have to go anywhere to doing it. You don't have to get up and shower and go to a job or go to a computer. Simply by owning that stock, you're going to continue to receive income over the year. Those are called distributions. And then hopefully if the stock value goes up over time, that's called appreciation. Your stock will be worth more years down the road. In real estate, you probably already guessed, it's going to be a rental property, right? It's an asset. It's a large building. May not, and even a small single family is still a large building compared to like a share of stock, which is a piece of paper. So you're owning an asset, real estate, land, buildings, structures, with the intent of holding it long term and having it generate income for you. Here, instead of called a distribution, it's called rent. Right? So if you own a stock, you get distribution payments monthly or quarterly. And when you rent out a rental property, some real estate, you're going to get rent, most likely monthly. Okay, and of course that asset can appreciate over time just like the stock can, and hopefully it's worth more years down the road and you've got some equity growth. Okay, but right now we're not talking about the equity growth. We're going to talk about the actual income generated from these rental properties, and that's called rent. Okay, so at the bottom, just some more examples: stocks, bonds, CDs, savings accounts, and of course rental properties. All of these things generate passive income. Okay, so that's passive income, and it's the reason we like passive income is it's taxed with fewer things. I usually say taxed at lower rates, and it's not the rates necessarily that are lower. It's just that it's only taxed at 2 levels, whereas the rest of the income that we're going to talk about in a minute is going to be taxed at 3 levels. It's going to be taxed 3 times, and passive income is taxed only twice. Okay, so with passive income, you have 2 taxes that apply to all the passive income you earn: state and federal income tax. Okay. Nothing we can do about this. It's kind of like can't avoid death and taxes, but there are some taxes we can avoid. But the state and federal income taxes we can't avoid. Our federal income tax schedule is a graduated schedule, if you didn't already know that, which means your first dollars are taxed at lower rates, and then your larger amounts that you make later, at higher income levels, are taxed at higher rates. And currently, it goes from about 0% to about 36%. When you start making over hundreds of thousands of dollars. Okay, so what you got to understand about the graduated tax rate is just because you might fall into, let's say, the 35 or 30% tax bracket, that does not mean all of your income is taxed at 30%, because again, it's graduated in chunks. So $0 to X dollars is taxed at 1%, and then from that level to the next level is taxed at a slightly higher interest rate, so higher rate. And the average then is sort of what your effective tax rate is, and it's usually much lower than what your top tax bracket is. State income taxes vary greatly state by state, so you might want to just check with your CPA on how your state does taxes. Most states seem to be about a flat tax, 4 to 6%, just flat tax, not graduated, pretty straightforward. But some states do have graduated income taxes. And a couple of states have 0 income taxes. Don't always think that that's going to be a windfall from a tax perspective. Say, I'm going to move to a state or start filing taxes in a state that doesn't charge an in-state income tax, and they'll save all this money. If you do live in those states, most likely, and most of those states have higher other kinds of taxes: property taxes, sales taxes, use taxes, these kind of things, to make up the difference and pay for state things, because they're not collecting a state revenue. So at the end of the day, you're probably going to be paying just as much in those states as anywhere else. But of course, there are variations, and some states have higher tax brackets than others. So it is something to kind of look into. Okay, but what to know about passive income is that it's only assessed as state and federal income tax. Okay. Ordinary income. Now this is the income that you're most likely familiar with. This is the income you would receive from your day job, a W-2 wage. Okay. This is income that is generated by actively being engaged in some kind of business that is producing you a salary or a return for the work that you put in. Okay, so that's why I like the word active rather than ordinary, because you actively have to be involved in generating income. So when you go to your day job, you sit at a desk and you crank out whatever for 8 hours a day, that cranking out of stuff is generating and the justification for paying you your salary. Okay, and so it's considered ordinary income, and anytime you've had a day job, this is the income that you've had. If you've ever paid W-2, this is the income that you've had. Even if you've been paid 1099, that there's a little variability there. We're going to talk more about 1099s later. But just because you're paid 1099 doesn't necessarily mean that it's going to be passive or necessarily active. If you're an independent contractor and you're building houses for your day job and someone pays you 1099, that's still considered active or ordinary income. And in fact, now that you're in real estate and whether you go to a day job, and you may still go to your day job and earn your W-2 salary, but on the side you might be doing flipping or wholesaling or bird dogging or a real estate agent, etc. Okay, all of those ways of earning income in real estate, which are going to be through a 1099, because in general, you're probably going to be an independent contractor, or you're going to own your own business doing those things. Those are considered active or ordinary income streams, okay? And they're going to be taxed differently. Ordinary income is taxed at 3 levels, so it's assessed to 3 taxes. Of course, there's state and federal income tax. We already talked about that. Again, we can't do anything really about those other than moving states. And then it adds on the self-employment tax. Okay, that's an additional tax that your ordinary income is subject to. You're probably familiar with the self-employment tax. You may have heard it called the employment tax, and you've certainly had experience with it, whether you know this or not. When you had your W-2 job and you went to work, and at the end of the month or every 2 weeks, you got your pay stub, and it showed your gross salary, and then there were all those little boxes of deductions and withholdings, and then you had your net salary, which was the actual amount that you put in your bank account. Okay, you probably remember your employer saying, oh yes, those are the employer taxes, employment taxes that are deducted for Social Security, Medicaid, Medicare, that contributes to those funds, which you will receive later when you receive Medicaid or Medicare or Social Security. So what the government's doing is it's collecting those taxes now, putting them into a pool of funds that then get paid out to you later. So you do get that money back, but it does come out of your paycheck. And that's the one we're going to be talking about now and for the next few slides, because this is kind of the bigger one. And so with the self-employment tax, you probably remember your employer at your W-2 job saying, oh yeah, the employer pays half and you pay half. And your half is what's coming out in those little boxes, okay? And that's true. Your employer paid half and you paid half. But now that you're self-employed and you've got your flipping business or your wholesaling business or your real estate agent business, you're now both the employer and you're the employee. So you pay both halves of that tax, and that tax is 15.3%. We're going to get into the details in just a few minutes. But so, in other words, the active income streams that you're making in real estate are going to be taxed first at 15.3% of the self-employment tax, and then you're going to pay the state and federal income taxes. Okay, and what we're going to be talking about a little bit later is how to reduce this self-employment tax. Okay, but now let's get just the difference between passive income, which is owning a rental property, and active income or ordinary income, which is pretty much everything else in real estate. So that's the easy way to kind of remember this. Rentals are passive, everything else is active. Okay, so more details about this self-employment tax. And again, it's 15.3%. And it goes to Social Security and Medicare, to these funds. The Social Security portion is 12.4%, the Medicare is 2.9%. That's where you get the 15.3%. And it's taxed on your business taxable income. Okay, so how does this kind of play out? And where does this tax get assessed? It kind of depends. The way you should be doing it, especially if you've been taking my classes in class number 1 in asset protection, you should have a business entity set up. For your flipping, for your wholesaling, for your real estate agent business, okay? And that business entity is going to file a tax return, and it should file an S-Corp tax return. We're going to talk about that in a minute. That's how we save on taxes. But let's say you just had an LLC without that special tax savings thing we're going to talk about in a minute. All the income that comes into your business, right, that's your gross income. It's all the commission checks, all the seller proceeds from the sales of your flips. And you got your gross income, and then you deduct off all your business expenses, not your personal yet. We're not there yet. So just your true business expenses get deducted off, and then you get your business net or your profit from the business for that year. And once you get the profit for that business that year, you apply the 15.3% to that amount. Okay, we'll talk about how that gets applied in a little bit, but that's if you let's say you had a flipping business, you flipped 4 homes this year, you made $100,000 net. That's your net business profit from these 4 flips. You're going to pay $15,000, $15,300 to be exact, of that $100,000 in the employment taxes. Right off the top, $15,300, boom, gone. Then you take that $100,000 and you move it over from the business tax return, the LLC's tax return, over to your personal tax return 1040, where it gets assessed the state and federal income taxes. Okay. Now, if you don't have an LLC set up, you're running your business without any kind of entity, that's all going to get reported on Schedule E of your tax return. So all of your flip money is going to get reported on Schedule E, and you come up with a bottom line of that $100,000 net. You're going to pay the 15% right there, and then it's going to go over to the 1040 side where you pay your state and federal income taxes are based. Okay. So that's where it comes from. It's based on your business net income, because everybody knows once they move that money over to their personal side, the 1040, they start getting all their personal deductions, right? And that's where it really gets lowered down, okay? But that's after we've applied the 15.3% to your business taxable income. Because again, this is employment. This is the taxes that you would have paid at your day job for engaging in a work. And so it's a business tax. Technically, it's a tax on employees, but it's a business tax, not an individual tax. Okay, so how do you know which is which? Now, I've given you some examples already. Rental properties, passive. Flipping, wholesaling, bird dogging, real estate commissions, real estate contractor, even hard money lending, all those are probably, especially hard money lending, are considered active or ordinary income. So how did I come up with that? How did I come up with that list? Well, I went to the IRS code, which is what all of us do. And this is how the IRS defines income as ordinary. If you are regularly and consistently engaged in a business, then the income you get from that business is considered active or ordinary income. So it's very obvious your day job, you regularly and consistently go to work. You go to work Monday through Friday, 9 to 5, you're regularly and consistently engaged in that business, and the money, the wage, the salary you get from your day job is going to be ordinary income because it's regular and consistent. Okay, so now let's take it over to our real estate side and say someone says, hey Jeff, I did one flip last year. Is that going to be ordinary income? Well, this is kind of where you have good discussions with your CPA. Probably not. You just did one and maybe you tested it out and you decided, you know what, I don't like flipping, I don't like real estate, I'm getting out of the business, right? Maybe not. But most likely your accountant's still going to call it ordinary income because it's a business that people do. But let's say you did 2 or 3 flips this year. Then absolutely that is enough to be considered regular and consistent during the year to be engaged in the business of flipping. Okay, wholesaling, bird dogging, kind of the same thing. If you are regularly and consistently doing those things to generate income, that income is going to be active or ordinary income. Okay, let's look at hard money lending. And this is kind of where it gets a little bit more gray area, to be sure, but it's a good example to illustrate the difference. Let's say you had a flip project and your mom wanted to loan you the money and she loaned you the money and she makes her interest return on the loan that she made you. And she does this once a year, maybe every couple of years, and she's just doing it to help you out. She could probably claim that as passive income, as interest returned on just a loan, okay? Because in general, interest on a loan is a return on an investment, right? When you make that loan, you're investing in somebody who's giving you an interest rate return. And so it's, she could probably call that income off those loans to you as passive income. Now, if you look at a hard money lender, somebody who's in the business of hard money lending, who loans out to lots of investors on a regular and consistent basis throughout the year, year after year, that money, that hard money lender is going to be considered ordinary income. That hard money lender is going to be taxed at all those 3 levels, and it's not going to be passive, which is what you might think of with a loan. Okay, so again, it's not what you're doing, but it's, are you doing that regularly and consistently? Okay, and this definition is really, really, really important. So that's why I've got its own slide, and I've spent a couple minutes talking about it, and I want to keep talking about it because it applies in a lot of situations. Not only does it apply here with the types of income streams we're making in real estate investing, but when you get into sort of things like self-direction, which we talk about in another class, and even have a mastery course on. The UBIT tax, and that's a big deal for self-directing retirement accounts, is whether or not the UBIT tax is going to apply. And guess what? One of the UBIT taxes applies to income your retirement account makes if your retirement account is regularly and consistently engaged in that business. Okay, so this definition is really, really critical because it does apply in other situations in real estate. So one is kind of, keep your eye on. And now to take an example kind of on the other side, let's look at a rental property. Like we said, rent on a rental property was considered passive income, right? You own the building, the house, the real estate, and you're holding it for the long term, and you want it for the investment purposes, and you're collecting a rent every month off of it, kind of like a dividend on a stock. We've said that rent on a rental property is passive income. So you might be thinking, well, wait a minute. If I actively manage my rental property, I have to locate and screen tenants, collect applications, collect rent, make repairs, evict tenants when they don't pay. It's a lot of work to be a property manager. And when you manage your own properties, it can feel like you're doing a lot of work for those rent checks every month, right? So is managing your property regularly and consistently engaged in a business? The good thing is the IRS has said no. Okay, that is a nice thing the IRS has actually done for us, is even if you self-manage your rental property, which looks like you're actively engaged in a business, the IRS still considers the rent you get as passive income. So you don't need to worry about that. Now, let's say you are a real estate agent doing property management for others. Now you're regularly engaged in the business of property management because you're doing it for others. You don't own those assets that you're managing. You're managing other people's assets, and the commissions that you get for managing other people's rental properties will be considered active or ordinary income. Okay, so hopefully we've gone over a number of examples of passive versus ordinary income, and for a good general rule of thumb, the only thing you need to remember is rent on rental properties, residential or commercial, doesn't matter. Rent on rental properties is always going to be passive income. And pretty much anything else you do in real estate is going to be active income if you do it often. Okay? So, sources of REI income, giving you lots of these examples already. So, of course, these are ways to make money in real estate. So, okay, there's holding rental properties. We talked about that. We talked about flipping houses. We talked about wholesaling and bird dogging. We talked about being a contractor. Okay. We've also talked about being a real estate agent. Okay. Real estate agent is another way of making money in real estate. You can be a title officer, a loan officer, appraiser, an inspector. These are sort of the ancillary real estate businesses that a lot of investors also do because they just have experience in real estate. Okay. Everything on this list is going to be what kind of income? Okay, think for a minute. It's going to be active income except for the holding the rentals, okay, which will be passive. Okay. Hard money lending, again, already given this as an example, but it was a great example to go through to kind of illustrate that regularly and consistently engaged in a business, right? A one-off loan that your mom or you might make to somebody, probably passive income, don't worry about it. But if you want to become a hard money lender and be in the business of it, then one, take our class number 3 and learn about hard money lending, or just consider it active income, and we'll show you how to save taxes on it down the road. Okay, so that's what we're doing. We're going to segue into reducing taxes. Okay, passive income. There's really nothing we can do from a true income tax standpoint on reducing the state and federal income taxes. Okay, work with your CPA. I always recommend having a yearly review with your CPA about your business or businesses and how you're generating income, because it will change over time, right? You may have a great paying day job and very little real estate income, and over time you may reduce your day job, may even quit your day job and convert to a full-time real estate investor. And of course, your taxes are going to change. So have a yearly review with your CPA just to kind of get an idea of, any suggestions that he or she might have to help reduce on taxes or how to change things, etc., to help lower your tax burden. And with the kind of the income side of things, the state and federal income taxes, it's a balancing act. And what do I mean by that? Of course, you want to reduce taxes as much as possible, but to reduce these taxes the way we're talking about right now, you'd have to come up with more deductions, right? More personal or business deductions. And the more write-offs you get, the more deductions you get, including depreciation, which we're going to talk about in a bit, you can lower your tax burden. Okay, but the more deductions and write-offs you take, it's going to lower your taxable income. That's good for taxes, but it's also bad for qualifying for mortgages. Okay, so you're in the world of real estate, and if you want to go pick up rental properties and get, your 5 to 10 rental properties in your name with mortgage qualification, you don't want an income that's too low either, because you might find it difficult to qualify for loans. And so a lot of investors don't take all the write-offs they actually can, because they need to keep the income level high enough to qualify for mortgages until they can build more of a portfolio. Okay, so for passive income, again, there's not a great deal we can do at this, at sort of this basic level to reduce taxes, other than having good conversations with your CPA and just looking into what write-offs and deductions you can take. Okay, now the ordinary income, that we can help you reduce. Okay, and the way we're going to reduce the taxes for ordinary income is run the money through an S-elected entity. What do I mean by an S-elected entity? Well, that letter S comes from subchapter S of the IRS tax code. It was a chapter that was created by Congress intentionally to provide some tax benefits, some tax relief to small businesses. Okay, and because it's called subchapter S, when we're talking about this, people have heard S Corp or S Elected LLC. That's what we're talking about here. An S Corp is a corporation that has elected to be taxed under subchapter S of the tax code. An S-elected LLC is an LLC that's been elected to be taxed under subchapter S of the tax code. So that S really just means the way the business entity is being taxed. Okay, and here you can use a corporation that's filing under subchapter S, or an LLC that files under chapter S, or even a partnership that's filing under subchapter S. In other words, it's that subchapter S that you're really looking for. And we do that by making a tax election. That just means we fill out a little form, send it to the IRS, doesn't cost anything, it's free, and it tells the IRS, hey, I want my corporation, I want my partnership, I want my LLC to be taxed under this subchapter S. And now we've got either an S Corp, an S-elected LLC, or an S-elected partnership. And instead of filing a corporate tax return or a partnership tax return, we're now going to file what is commonly known as an S Corp tax return, because we're filing under subchapter S of the tax code. Okay, so hopefully that makes sense on what that S elected or S Corp and all that S means. But that subchapter S of the tax code is where we get the tax savings. Okay, because what it does is it turns some of our ordinary income that's taxed at 3 levels, and it turns it into passive income, which is only taxed at 2 level. So it's a sort of a magic trick. So it takes all that ordinary income and splits it into 2 categories. Some of it's still going to be called ordinary income, taxed at 3 levels. There's no way around all of it. You got to pay yourself a salary, which we'll talk about in a second. So they have to have some ordinary income, but the rest of it you can now call passive. And you can't do that unless you have 1, a business entity set up, and 2, that business entity has done the S election and now files under subchapter S of the tax code. So let's see how specifically this kind of works out and how we can reduce taxes. Okay, so simple example, real estate agent makes $100,000 this year in commissions. Okay, so that is all of her commissions less her marketing and other business expenses. And right now, she does not have any entity set up. She's just a real estate agent doing everything under her personal name because she hasn't taken my classes yet. So this year, when she files her tax returns, the very first thing that's going to happen, she's going to file all of her commission checks on Schedule E of her tax return, since she doesn't have an LLC set up. So it's on Schedule E of her tax return. And at the bottom of that page, it's going to tell her that she has to pay $15,300 in those employment taxes. Okay, so she writes a check, or she sets that $15,300 aside because she knows that she has to pay taxes on it. And then that $100,000 gets applied to her 1040, and then she starts taking out her personal deductions and personal write-offs, etc., and calculates what her federal income tax will be, and then she goes over to her state tax return and files out what her state income tax will be. Okay, but that $15,000 is a big chunk, and it comes out before she's even paid any of her state or federal income taxes. Okay, so what we're going to do is help her reduce that $15,000 tax burden. And again, that's if she makes $100,000 a year, year after year, that's $15,000 every single year, year after year. Okay, so what she's going to do, she's going to call me up and say, hey Jeff, I really want to save money on my taxes because I'm a real estate agent, and my real estate broker pays me a 1099 at the end of the year. And so I say, great, we're going to set up an LLC. That's my preference. I don't really do a lot of corporations anymore. So we set up an LLC and we file that little form with the IRS to make it S-elected. So now she has an S-elected LLC. Awesome. Okay. So this year she's going to file all of her commission checks not on Schedule E of her personal tax return. Her accountant is going to do an S-corp tax return. Okay, and file a separate tax filing for the business entity. And in that tax filing, of that $100,000, the accountant has to decide how much is going to be salary and how much is going to be distribution. Okay, because again, this is a business and she owns the business and she works for the business. So she's an owner of the asset, the business, and she's an employee or wage salary person of the business. Because now this S-election allows her to create the two different roles or two different jobs in the one business. Okay, so she does have to pay herself some salary, some ordinary income as the employee of the company to actually do the work, because she is doing work as a real estate agent, right? That's the regularly and consistently engaged in a business. So somebody has to be paid to do that. So we're going to decide to pay her $50,000 as a salary. Okay, that's going to be ordinary income, and we're going to create a W-2. So we're actually going to run this through payroll. And you really should run this through payroll. It is possible for your accountant at the end of the year to do what's called kind of like a fake W-2 and just take the income and call some of it salary and call the rest of it distribution. And for their first year setup, that's probably fine. But after that, you really should set up a payroll and actually pay yourself a salary. And don't think it's a big deal. It's not. It's super easy. There are many companies out there that do payroll. They can do it monthly, twice a month, quarterly, or there are payroll companies that will do it just when you ask them, once or twice or 3 times a year. And it's usually $50 to $100, so it's not exactly expensive. And what they will do is they'll pull money out of your business account. They'll do all the withholdings just like an employer would. They'll send that to the IRS, and then they'll send you a check with your net pay stub, just like any employer would. And at the end of the year, they're going to send you the W-2. So they'll take care of it for you, and it's not expensive, and I highly recommend it. Your CPA might do it too. I find that CPAs very often are a little bit more expensive to provide that service than a payroll company. But check both out and compare cost, and just set yourself on a payroll. And again, it doesn't have to be regular. It has to be like twice a month. You can just call up and say, hey, I want to do a quarterly check, or you want to run a payroll, and they'll just do it for whatever amount. You can say, hey, I want to run a salary of $20,000 this month. Okay, and then 6 months later, you say, hey, I want to do another payroll run of $30,000 to pay myself $30,000 in salary, and boom, in those 2 paychecks, you've paid yourself $50,000 salary that year, and you only ran 2 payrolls. Okay, so but back to our tax savings. So in this entity now that she set up, she pays herself $50,000 as salary. That's W-2 ordinary income, subject to the 3 levels of taxes. The rest of it now she gets to take out as a distribution, right? As the owner of the company, which is owning an asset. And as the owner of the company, she's not doing anything to own it. She simply owns it, just like owning a rental property. And so that $50,000 comes out as passive income, just like the rent on a rental. Or to be more specific, it's really a dividend on the shares of stock that she now owns as the owner of the business. That's the way the IRS looks at it. They look at her as the owner of the business owning all the shares or all the ownership of this business, and that $50,000 is just her distribution check for owning a share of her business. Okay, so now that she split $50,000 as salary and $50,000 as distribution, that self-employment tax at 15.3% is only applied to half her income. So she's now only paying $76.50 in those taxes. She just saved simply by setting up an LLC and filing that form with the IRS. And of course, she's going to have to pay a little bit in payroll to get those payrolls done. And she's going to have to pay her tax accountant a few $100s to do the S-corp tax return. So, it did cost a little bit of money, but probably far less than, $1,000 or $1,200. And she saved $7,600. And then she's going to save that $7,800 year after year after year after year. So setting up that entity, getting that S-election, is going to save her tens of thousands of dollars, if not hundreds of thousands of dollars over the lifetime of this business and her career as a real estate agent. Okay, I am very often surprised at real estate agents who just don't do this. It's amazing. And they say, oh, well, I don't make that much money. I'm like, well, how much money do you make? And they're like, oh, make just like 60 or 70,000. I'm like, holy cow, you could still be saving $3,000, $4,000, $5,000 a year. Why don't you want to save? Why do you want to pay more in taxes? Okay. So anyway, that's the large overview of how the S election saves you money by taking what is all ordinary income and splitting it into the two categories. Okay. Now let's look at capital gains taxes. Okay. This is a sale of a long-term asset like a rental property. And so the rent you get is going to be passive income. But at some point, you may want to sell this rental property. And you're going to have to pay a capital gains tax on it. And that capital gains tax is based on the sales price, what you sell it for at the end of its life or when you get rid of it, and your basis. Okay, what is your basis? It's a tax basis. Okay, your tax basis begins, in the most simplest way to describe it, at your purchase price when you first bought it, less any depreciation you've taken over the years. So if you buy a property for $100,000 and 10 years later you sell it for $200,000, if you did not depreciate that asset, your taxable capital gains income is going to be $100,000, the difference between your initial purchase price and your sales price. And this is no different than buying a stock at $3 a share and then selling it at $5 a share. You're going to pay the capital gains on the difference between the 3 and the 5. Okay, but in real estate, we are allowed to depreciate. So you can take that asset and depreciate it. We'll talk a little bit more about depreciation in a second, but what it does is by depreciating it, you're going to get some tax write-offs today. Okay, it's going to save you a little bit of taxes today, but what you're doing by that depreciation is you're lowering the tax basis. So you're going to pay more capital gains later. But most investors still depreciate quite a bit because if you're saving taxes now, you're probably saving taxes on ordinary income, or when you're making more money and your income tax brackets might be higher. So we're assuming that you're paying more tax per dollar on today's money than by selling an asset later and only paying the capital gains tax later. Because as you notice, here are the capital gains taxes. If it's under $40,000, it's 0%. But if you make capital gains over $40,000, it's going to, or sorry, excuse me, if your income is less than $40,000, you pay 0% tax on capital gains. But that's very few people in America that make less than $40,000. You'd have to be pretty poor. And of course, if you're in real estate, you're making far more than that because you're motivated, you're self-employed, and that's the reason you're in real estate in the first place. So for most people, most Americans, the capital gains tax rate is going to be 15% because they're in between the $40,000 and over $400,000. That's most Americans. So for most Americans, you're going to pay 15%, and 15% is probably much less than what your income tax is, especially if it's ordinary income you're paying today on your other income. Okay, so capital gains taxes are lower, which is why we depreciate now to get the income tax deduction, and we pay more or have a bigger basis when we sell properties and pay the capital gains tax because it's only 15%. And if you make a lot of money, you're wealthy, that capital gains tax does go up to 20%. So it's a little higher for the wealthy when they sell long-term assets. And again, these they change very often, in fact. And so like all of our tax rates and all of our tax schedules, they do change very often year to year. So you got to keep an eye on them. Okay. And the ones that parentheses are just whether or not you're filing married as a head of household or single kind of thing. So, but you can just check with your accountant. Most likely, the rule of thumb is you're going to pay 15% capital gains tax on any time you sell a rental property. Okay, depreciation and cost segregation. This cost segregation is a big topic now. I find that, I think it's great in real estate. If you stay in the game long enough, you see things go around and around and around. Wholesaling has kind of been a big deal. It's kind of fading right now. Everyone's now talking about cost segregation. People are talking about more multifamilies and syndications now. That seems to be a big topic. My guess is we'll go back to single families and rentals and flips, and then we'll go back to some bird dogging. It's just sort of whatever sort of the hot topic of the day. And cost segregation is kind of the hot topic of the day I'm seeing. But again, we talked about depreciation. And it's great because it will save you taxes now. It's giving you some tax write-offs today, but it's going to lower your tax basis, and you're going to end up with a larger taxable amount when you sell assets later. what cost segregation is, it's depreciation on steroids is really what it is. The IRS assumes that every long-term asset you own, whether it's a rental property, whether it's a computer at your office, or a desk even, the IRS assumes that it has a lifespan, that over time it just gets worse and worse and worse, and at some point it's just not worth anything. The great example is a computer, right? 5 years later, a computer is pretty much an obsolete machine. You need a new computer almost every 5 years. And so what the IRS does is says, well, if you buy this asset and it just gets worse and worse and it's worth less over time, we're going to allow you to depreciate that asset and get some tax write-off because of it. Okay? And residential properties are depreciated over about 27 years. And so that's the lifespan that the IRS considers for a rental property. Now, of course, we know that we're in it for the long term, and we hope that our rental property actually becomes more expensive, right? It appreciates down the road 10, 20 years later, and that is true, but that's appreciation due to market forces, right? You have to look at the property itself. If you have a rental for 10 years, how does that rental look after 10 years if you haven't done anything to it, right? It's going to be beaten up. You're going to need new paint, new carpet, new flooring, new cabinets, new countertops, right? Because it wears out over time. And that's part of what we do as real estate investors. We keep improving those investments to keep capturing more and more equity growth, okay? So normally you can depreciate your rental property over the course of 30 years. So if you had a rental property that had a valuation of $100,000, you could take about 1/30 of that, give or take, and reduce that value every year and get a little bit of a tax write-off. What cost segregation does is it takes your rental property, and instead of subjecting it to on average, I use this as a rule of thumb, the 30-year depreciation schedule, then it actually separates out the component parts of the house. Each has its own depreciation schedule. The plumbing, the electrical, the flooring, the roof, the land, fences, all these different components of real estate depreciate at different rates. Just like a computer depreciates in 5 years, a rental property, if you don't cost segregate it, depreciates in about 30 years. But the component parts, some of them depreciate much faster. So what cost segregation does is allows you to take bigger depreciation now and get more tax write-off now. Okay? So it is a tax savings thing. By giving you bigger depreciation numbers, which are lower your tax burden today. Cost segregation is pretty expensive to do. They have to be done by a professional cost segregator and analyze, and they will come up with your depreciation schedule. Okay? Typically, it's not worth it on a residential single-family rental property. Even a duplex, triplex, fourplex, most investors find that the cost of doing the cost segregation isn't necessarily a great benefit, or kind of outweighs the benefit of doing the cost segregation, getting the extra depreciation. But on commercial properties, apartment buildings, commercial buildings, offices, retail, etc. In those situations, the cost segregation can actually save you a lot of money, and it is far more common for commercial real estate investors to do cost segregation. But what I'm finding now is because so many people are talking about it, people are like, oh, do I do cost segregation on my rental property? What kind of rental property is it? Oh, it's a single family residence. I'm like, and how many do you own? Oh, just the one. I'm like, yeah, don't. Okay, probably not worth it. Okay, so that's cost segregation. Some other terms: professional real estate investor. This is an IRS classification that if you meet the definition, and we have some webinars on kind of all of these. These are all sort of separate side topics that we talk about often. But a professional real estate investor, if you meet the qualification, you have to work so many hours in real estate. It has to be such a chunk of your income and your time and the amount of work that you do. You can actually realize some tax benefits by being defined as a real estate investor. It will change how some of the things are taxed. It'll actually increase your taxes in some areas, but it's going to give you more deductions in other areas. And so if you do spend a lot of time, or you are a full-time investor, absolutely talk to your CPA, run the numbers of what you're making, because everybody's numbers are going to be different. That's why I don't give a lot of examples here, is because your numbers and your overall income is going to just be different. So let me do that little side note now. When we talk about taxes, especially those employment taxes, right, that the real estate agent made in her real estate business, right, she may have a day job And she may have a day job where she makes $100,000 a year and she just does real estate on the side. And in her day job, she's already paying employment taxes on $100,000 because that's her income, right? And as a day job, it's W-2 wage, all of it. So she has $100,000 in income that is subject to those employment taxes. And then her real estate business is really the other $100,000 on top of that, okay? And those self-employment taxes do go down after you make about $125,000, $130,000. And that, of course, number changes over time as well. And so believe it or not, the wealthy only pay 2 or 3% in employment taxes on their ordinary income because they've already maxed out the 15%. Right? And that's just another wrinkle, another issue that you need to understand in taxes. So I will say this over and over and over again. Now that you have these terms and you know these strategies and you know these things, go to your CPA, sit down with him or her and discuss how you make your money, where you make your money, all your sources of income, and devise a strategy with your attorney and your CPA on how best to reduce your overall tax burden, because it is highly individual and it's going to depend on you and your deductions, your family, your deductions, how you file, your other sources of income, etc. Okay, all I really want to do with this class is introduce you to these topics so that you are more educated and can have more competent conversations with your other professionals. Okay, so anyways, back that real estate and professional real estate investor. If you are full-time, that is a conversation you should have to see if that will help lower your tax burden. Remember the sale of your primary residence tax exemption. Okay, you can sell a property that you lived in for 2 of the last 5 years, and you can capture up to $250,000 or $500,000 tax-free by the sale of your primary residence. Okay, that's a great tax exemption. It's for homeowners, people. It's for your primary residence. You can't use it for your rentals or anything like that. But kind of keep an eye on that. Some people like to house hack, and that's great. And they'll live in a house for a very long time, and then they'll want to maybe turn it into a rental. But what you got to do is you got to go, wait a minute, how much equity do I already have in this home? And once I turn it into a rental, after a couple of years as a rental, I no longer can sell that and get this capital gains tax exemption, right? It may be smarter to actually sell that house and get that equity tax free completely, rather than turn it into a rental business asset that's going to be subject to capital gains tax later. Okay, so just something that you should be thinking about and run through your CPA. 1031 exchanges. These we do on our rentals. So this is not primary residences. It must be a rental property, and you must sell a rental property and exchange it for another rental property. The new tax laws that went into effect in 2018 really limited 1031s. They made it much more difficult, believe it or not. And so they shrunk down the kinds of exchanges you can do. You used to be able to sell a rental property and maybe buy into a business that owned rental properties. Now you have to essentially sell real estate, buy real estate, and that's basically it. But what a 1031 exchange does is it defers taxes. It kicks the taxes down the road. So when you sell your rental property today, you don't pay any capital gains taxes on it, because you're going to immediately or shortly thereafter put that money into another rental property. And we do webinars. As a 1031 exchanges is a great way to move up and really increase wealth. That's a whole nother topic. But the 1031 is once you've exchanged that property, you now have another rental property. You get that equity growth for the next 5 years or 10 years that you hold your second property. But if someday, if you ever do sell that real estate, you'll then pay all the capital gains that you've been accumulating over all of those exchanges and all of those properties over the years. Okay, but it can be a tax advantage because it could be a tax deferral at this point. Okay, so those are some of the bigger topics. If you got more questions, just check out our library and webinars. We do a lot of kind of tax stuff. We get a lot more details. Check out the textbook for you. Taxes are a great topic because it's something we just always want to reduce. But I want to give a big thank you to all of our current real estate investors out there, and thanking you for joining me today for our professional investor class number 7, the last of our professional series. So you now have completed your professional series. You can take the exam just below the video and get your certificate and your discount code for one of our mastery courses. So again, remember that knowledge is power, and happy investing.